Welcome everyone to this session for the financial statement of the limited company. This is our level 4, one of the very important paper for the AAT. Uh, this paper is very important for the student who planning to start their career in the finance area. For example, in future, if you like to work for your client, if you like to work in a practice, so this course will be very crucial for you, because from this course we're going to learn how to prepare the financial statement, how to prepare the consolidated financial statement, how to prepare the cash flow statement. So this course is a really important for the financial accountant. So let's talk about little bit financial statement of limited companies. Now the limited company, we already know limited company means like this has to be corporated from the company house, and every single limited company they have to regulate it by the Company Act 2006. That means there are certain conditions, there are certain guideline or compliance every single limited company we have in the UK they have to follow. Now one of the guideline for the limited company is they have to prepare the accounts and submit to HMRC after 12 months. So when the financial year will be ending, they have to prepare the financial statement and cash flow statement, some other things, so the set of account, and they have to submit certain documents to HMRC. The reason you have to prepare the accounts and submit to HMRC like to see your company's operation, and they like to see you paying the right amount of tax or not. That's the main reason. They want to see, are you paying the right amount of tax or not, and that's why they like to see your financial statement. Now this paper is quite straightforward. It's not very tricky. And the good news for this paper is it's not like a management accounting. If you made a mistake in one entry or one number, the whole number will be wrong. So this paper will have individual marks. For example, if you prepare the financial statement and if you made a mistake on one adjustment, for example, accruals and prepayment, you're going to lose the marks only for that entry, not for everything. So it's quite good news for all the student. So let's have a look what we have in this paper, and let's talk about the exam criteria and the question we're expecting in the exam. So if you look at the content, we have 11 chapter that we have to cover for this paper, and most important chapter that we have to cover from this course, that is limited companies financial statement. So we call this one chapter number 4. Is a very important chapter. Then statement of cash flow, very important chapter. Then we have group account, very important chapter, and interpreting of the financial statement, that is the ratio analysis. So this fourth chapter will be the main area we're expecting question in the exam. So let's have a look what is the marking area and how many marks we're expecting from which chapter. So the first one, understanding of the reporting standard. So we said understanding of reporting structure and ethics. From here we are expecting 7 marks. So 7% marks we're expecting from understanding of the reporting framework and the ethics. Now ethics will not be very difficult if you understand your fundamental principle of ethics, that is professional behavior, integrity, confidentiality and due care, competence and due care, confidentiality, and objectivity. If you remember your 5 fundamental ethical principles, the ethics will not be difficult for this paper. Then number 2, we're expecting understanding of the published financial statement. So understanding of published financial statement, and we're expecting 18 marks from this chapter, from this area. It could be like different chapter, because financial statement we have 3 or 4 chapter that is covered, so obviously maybe you have to focus all of these chapters. Then number 3, we have to prepare the financial statement. So we said draft financial statement, and that will give us 27 marks in the exam. So that's very important. You don't have to make the template. They will give the template anyway, but you have to know how to present the financial statement. Now we know the financial statement prepared based on the IS1. So IS1, International Accounting Standard. So this standard tell us how to present the financial statement. So you have to follow that template. So expecting 27 marks from this chapter or this area. Number 4, we have to draft consolidated financial statement. So this one is chapter number 10. So consolidated financial statement, and this will give us 20 marks. And finally, the last one is the ratio analysis, that is interpreting the financial statement, and that will give us the maximum 28 marks. So this is the 100 marks covering for this paper. The exam will be 2.5 hours. It will be marked by both computer and the human. So someone going to mark the writing area. For example, if the question asks to write a report or reply an email, this type of question, that will be marked by human. And if the question asks you some calculation or just pick list, so this type of question will be marked by the computer. So we can say the assessment will be marked by computer plus human. All right. And after that, finally, we expecting 8 tasks in the exam. So 8 tasks will be in the exam, and we have to score 70% to pass the exam. To make ourselves competent, we have to score 70% in the exam. All the 80 exam we have to score 70%. So it's like same. And that's all the briefing for this paper. Now let's move on to our chapters. Let's have a look what we have in chapters number 1. So we'll move on to chapter number 1, and we'll try to do some activities and try to explain some question from there. All right, in chapter number 1, the first chapter we have that is introduction to limited companies. So let's give some introduction for the limited companies. Now, the limited companies means the liability of the shareholder is limited. I'm sure by this time, all of us, we already know that the definition of the limited company. So limited companies. So that means the liability of the shareholder is limited. So for any reason, if the company fails or if the company closed down, if the company gone bankrupt, the shareholder will not be liable to pay anything beyond their investment, because it's a limited company and the business and the owner are separate. So we already know that the business and the owner are separate. So business and owner have no relationship. We have a business, we have an owner here. So for any reason, if the business fail, the shareholder will not lose any money beyond the investment. For example, if the shareholder or owner of the business invested £5,000 here, he will be only lose 5,000. So for example, if this person or if the business took a loan from the bank, and if the business gone bankrupt or dissolved, so the bank cannot come to the owner and say, sell your personal car or sell your personal asset and pay back the money. So they will be not personally liable for that. For example, for the sole trader or for the partnership, if the business fail, so the partners are personally liable for the debt, but for the limited company, they are not. So I'm sure when we are starting the level 4, by this time you already know what is the difference between this limited company and the sole trader or other thing. But this is the basic thing. So the liability of the owner are limited. This is the definition of the limited companies. So let's have a look what we have on the introduction. If we move to the chapter overview, we can see a few things here. Let's talk about all of this. The first thing we have here, new share at nominal value. Now the nominal value sometimes we call face value. Face value. The nominal value sometimes we called it face value. So this is the value when you open a company. For example, if I like to open a company here today in United Kingdom, so when I open a company, this company by default, it will tell me 100 share and £1 per share. So this one is the nominal value. The market value is the different from the nominal value. So this share can be sell in the market more than £100, but the nominal value will be still remain same £1. So for example, if I decided to open a company today, by default, the company will tell me 100 share, £1 each. So the company value is £100. Company value is £100. That's the nominal value. That means if something happened to this business, so I'm going to lose up to £100, not more than that. It's a very interesting because obviously unless you like to change it. For example, if you said no, I want my company have 1,000 shares, so you can change it to 1,000 shares. You can say I don't want the nominal value £1, I want the nominal value £100 each. You can make it, but no point to revalue or make a lot of valuation for your company, because the market value could be 1 million, but nominal value will save you because the value of the company is £100, so you're not going to lose more than £100. So that's the reason I would say every single company open in the United Kingdom, they keep the nominal value £1. It's a very like a standard. Everyone keeps the nominal value £1, and they keep the share 100 share. So later on, they can always raise the capital from the market by issuing new share. So this is when I have a share. So this is a one share, £1. This is nominal value. So this is the face value of the share. Now, the next point we have here, new share at a premium. So of course, when I'm going to sell this share in the market, I'm not going to sell for £1. That's my nominal value. I'm not going to sell it for £1. I'm going to sell it more than that. So if I'm going to sell more than that, what will happen? So for example, if the nominal value is £1, and if I sell the share for £2, if they sell the share for £2, so the difference £1, we call it share premium. So anything that is top of the nominal value, the difference is called share premium. So we understand the share premium. So that is, if anything, we sell the share in the market, and if we collect more than the nominal value, the difference is called share premium. The next point we have the bonus issue. The bonus issue is when we issue the share to the existing shareholder like free. For example, we said like this year, we're not going to give any dividend to the shareholder, but we're going to give some bonus share. So we said, for example, if you have a 5 share, you'll get 1 bonus share. So if you have a 5 share, you will get 1 bonus share. So the bonus share is quite common in the business, and obviously like that is only given to the existing shareholder. Now, the main point you have to remember for the bonus share is Because of the bonus share, there is no money in to the business. Because the bonus share is free, we give as a gift to the existing shareholder. So there is no actual money come in to the business. So bonus share is a free share to the existing shareholder. So you have to remember that because of the share bonus share, there is a no movement of the share capital. So the share capital does not increase, but the number of share is increased. For example, before that, the company have 100,000 share. Now, because of the bonus share, it will be added. So the number of share will be increased, but the capital remains same. Now, when the company issue sort of bonus share, what they do, they use the different account. So they can use their share premium account. So they might say, okay, because the share is free, so we have some money on the share premium that we charge extra to the shareholder for the new shareholder. So the money we have on the share premium account, we're going to use money from there when issue the bonus. So for example, if I give 5,000 bonus share and if the value is £1 each, so this £5,000, I'm gonna take it from the share premium account and I'm gonna put it to the share capital account. So we'll see some example how's it work, but that's how it is because bonus share we give free to the existing shareholder, so there is no actual money coming from the people from the shareholder. So we have to use some other account like share premium account. We took the money from there and put it on the share capital account because the number of share is going up, but actually no money coming to the business. Finally, we have the right issue. Now, the right issue is quite interesting. The right issue is given to the existing shareholder, but less than the market price. The reason is, let's say if the company decided to sell 5,000 share in the market, and the existing shareholder will tell, why are you selling to the new people? Because we are already the shareholder for this company. For example, if the Tesco decided to sell 5,000 share to the market, so already the people hold the Tesco share. They will tell like, why don't you sell it to me? Why you have to sell to the new people? So they can sell to the existing shareholder, but they will charge a little bit less than the market price. For example, let's say the market value of one share is £2. So rather than charging £2 to the existing shareholder, they sell it for 1.5. They sell it for 1.5. So this is the right issue. So right issue means you issue the share, the company issue the share to the existing shareholder, but less than the market value. So this is called right issue. So let's say, let me talk a little bit more about the right issue. So for example, let's say the company market value is £2 and company selling it for the right issue is for 1.5 and the nominal value is 1. So market value is not considerable here because I'm issuing the less than the market value. So 1.5 is the right issue and nominal value is the 1. The difference is 50 pence. So whatever is extra, whatever is above the nominal value, we call it share premium. So this 50 pence will go to the share premium account and the £1 will go to the share capital account. So remember that every time if we raise the money from the market, we have to split it. We have to see the nominal value always go to the nominal value account, the share capital account. Anything I got extra, then the nominal value that goes to the share premium account. All right, so if we do some more example, will be more clear after. Let's talk about the limited companies. Let's have a look what else we have here. So we have the purpose of the financial statement. So make economic decision, assess the performance of the management. So why we need to use the financial statement? The reason is, for example, if I like to make investment in Tesco today, before I make the investment, I like to see what is the condition of the Tesco. I like to see how they are doing. What is their financial statement saying? So based on that, I can take the decision. So obviously, for the decision purpose is very important for the financial statement. And the user of the financial statement is everyone. For example, employee, for example, the lender, the government, the public, everyone is the user of the financial statement. But the main user of the financial statement is the shareholder, because they invested their money on the business, so they want to see how the business is doing. So the business want to know, the shareholder want to know, the management are focusing on the business, they're maximizing the profit, and that this is they are the main user of the financial statement. Top of that, the government want to see the financial statement, because government want to see the company paying the right amount of tax or not. On the other hand, the employee and the lenders, they want to know, like, okay, the company is liquided enough to pay the loan, or the employee want to see like their job is secure, the supplier want to know company have enough cash so that they can pay the money to the supplier. So for all of this reason, they are the user of the financial statement. Then the next point we have here, incorporated business. Now, incorporated means when you register on the company house and you have incorporation number. Now, the incorporation, that could be the limited company, and there is another sort of company called it corporation company. That is really big. So if we talk about the British Gas, if we talk about Google, they are kind of the corporation. But incorporation means when you register your company on the company house and you have a employ the limited company number and you have incorporation certificate. So this is the way you can have a separate legal entity. So as soon as you register with the company house, they'll give you incorporation certificate, and that one creates the legal entity or separate entity from the owner. So business will be treated as a human, so business will be treated as a person. So business can buy the asset, buy the car, buy the land on the business name, so they don't need the shareholder. The next point we have here, owners are called shareholder. Sometimes we get confused. Maybe the owner of the business is director. It is not. The owner of the business is the shareholder, not the director. Remember that directors are the people who run the business a daily basis. They are the employee. They receive the salary from the company. So director can be or cannot be the owner of the business. Director take the remuneration, director take the salary from the company, but they are not the real owner of the business. The real owner is the shareholder of the business. All right, so the financial statement, sometimes we call it a balance sheet. So profit and loss account, there is a combination of few things. So you will see what is that. But for the time being, you can see statement of profit and loss account. On the statement of profit and loss account, we have two categories. The first one, we want to say what is the gross profit and what is the net profit. Now, why we have to separate it? The reason it, some costs are directly related to the business. So for example, we called it cost of sales. So we have a revenue. Revenue means the sales. Revenue means the turnover. So sales, turnover, income is the same story. So revenue, sales, income, then turnover is the same thing. So if in the exam, if you see like they said turnover, they said sales, don't be confused. It's the same thing. Cost of sales. Cost of sales is the direct cost. The direct cost, the cost you have spent it to make this sell. It is not the indirect cost. The cost, for example, if I like to sell this pen, so I need to buy this plastic. So the plastic is the direct cost. This cost will come under the cost of sales. But if I use some heat and lighting, for example, to make this pen, I'm not going to use it as a direct cost because I don't know how much heat and lighting is here. So that is indirect cost. We called it overhead. Top of that, we have some other costs. For example, the finance cost, the accountant cost, the selling and distribution cost. This is non-production overhead. So we want to make it split so that we can see how much the profit we make after the direct cost and how much profit we make after the operational cost. So the cost of sales, there's a formula for that. There's opening inventory, and then plus purchase, less closing inventory. So this formula tells us how much is the cost of sales. And if we minus it from the revenue, the difference is called gross profit. I'm sure all of us will know this template. Then we have a distribution cost, admin cost. The question will give us how much is the distribution cost and how much is the admin cost. Admin cost is mainly the selling and finance cost, this type of cost, so like non-production overhead. And on the bottom, we have some word that we have already discussed, that is share capital, share premium, return earnings. So share capital, the capital we raise from the nominal value. Remember, the share capital account is the account we only consider that comes from the nominal value. For example, if I issue 1000 share and if the nominal value is 1, so 1000 will be the share capital. If I issue next 1000 share, another 1000 will come. If I sell one share for 100 pound, so 1 pound will be for the nominal value for each share, and 99 pound extra that will go to the share premium account. So share premium, anything extra I have collected because of selling the share, that is share premium. Return earnings means the profit. So basically, if I make a profit by from the business, all this profit we keep in the retained earnings account. So for example, it's like a accumulated depreciation account. So if you remember, all the depreciation up to today we called it accumulated depreciation. So same, likewise, if I have a profit for the last 5 years, all the profit we keep in one account, we called it retained earnings. So retained earnings is the profit after the dividend. So for example, when the company make a profit, so from the net profit they have to pay some dividend to the shareholder, otherwise shareholder will not be happy, isn't it? So after paying the dividend, whatever profit left over we keep on the retained earnings account. Now retained earnings account is the total profit account. So every time if you pay the dividends, your retained earnings will go down. If you pay dividend, retained earnings will go down. Then we have a revaluation reserve. Now this one can be realized gain or can be unrealized gain. Let me talk a little bit about the realized and unrealized gain. So revaluation reserve, for example, one business have a head office, and this building they purchased 100 years before. Now that time the price was 100,000. Now today in 2021, maybe the price is 1 million. So all this price gone up because 100 years back, maybe the price was really less for the building with the land. Now what will happen when they revalue the asset? The price goes really up. The financial statement shows there is a lot of value for the asset. Now they might say the difference, and they said it's a revaluation reserve. Now, unless actually we sell the building or the land, the money will not be realized. For example, on the financial statement, if I show the revaluation reserve is 1 million, and on the bank I see there is no money, and if I ask you where is the money, you said you have a 1 million revaluation reserve, and we said this is the building, the head office. So we are not selling this building, the land, but we have a revaluation. So obviously, if I revalue my asset, I am I'm allowed to show this one on the financial statement, but in a separate column. And this is called other comprehensive income. This is called other comprehensive income because this is not something we have right now. Only the money will be realized, only the money will be cash when I'm going to actually sell this asset. So that's the reason we cannot say it is a realized gain, and we have to show this one separate on the financial statement. So you're going to see how does it work in detail. And after that, you have a bank loan. I think nothing to discuss. The tax, the company have to pay corporation tax, CT. When you prepare the financial statement, you called it CT 600. So when you will be working as an accountant, when the client come to you and they said, can you prepare my accounts and submit to HMRC? Then you said, yes, I can do. And you called it CT 600. So CT 600 means the tax computation for the limited company. So this is all about the chapter overview. Let's have a look if we have any activities from this chapter. And let's have a look if we can do it really quick. So move to activity 1. All right, so let's have a look what we have in the activity 1. So on the activity 1, we can see it says which of the following statement is correct with a limited liability. So what does that mean, the limited liability? We already discussed that. Limited liability means if the company fail, so the shareholder will be protected. So they will never lose their personal asset. So they will only lose the investment that they make for the business, but not their personal asset. So we said that one. Shareholder of a company are protected in that way They can only lose their investment in the company should the company fail. If the company fail, they will be only lose their investment, nothing else. So this is the main advantage of the limited company. The next one we have here, the following terms used in relation to the preparation of the accounts. Now, when I said the accounts means for a limited company. Now, the accounts have five parts. The accounts that have five parts. The accounts normally, the main two part is the profit and loss account and the financial statement. This is the two main part. But top of that, the financial statement or the accounts have few more parts. So let's have a look at what is that part. The statement of cash flow is one of the part of the accounts. I'll tell you why. Because the accounts we prepare as an accountant, we prepare the accounts based on the accrual concept. And the accrual concept means doesn't matter we received the money or we paid the money. If the transaction is relevant to that year, we have to record it. Now, maybe I made a lot of sale, but every single sales I make is all credit, so I don't have any money. So, for example, if I look at the financial statement, I have seen the profit is 1 million. But when I look at the bank statement on the bank, I see we have only £5,000 left on the bank. Then I will be very surprised. Like, how come the profit is 1 million and on the bank account we have only 5,000? So then the reply will be from the director. They will tell all the sales are credit and no one paid yet. So because the accounts is prepared based on the accrual concept. So that's the reason to take the decision more accurately, we have to see the cash movement, how much actually cash we have in the business. And this is called cash flow statement. So on the cash flow statement, only we will see how much the business paid and how much the business received. So that will tell me actually the cash movement of the business. That's the reason we have to see the cash flow statement. The next one is statement of profit and loss account. That is very important. So from here, we calculate the tax for the business. Then the director's report. Remember that director's report is not part of the accounts. You don't have to give the director's report to HMRC. Now, when you prepare your annual report for the company, and that time you have a report from the director, you have a report from the CEO, you can put your corporate social responsibility, but you don't have to give it to HMRC as a part of the accounts. Statement of financial position, of course, it is very important because this one tell us how much asset we have and how much liability we have. Then statement of changes in equity. This one will tell us what is the movement, my share capital, share premium, revaluation reserve, and the return earnings. So statement of changes in equity is also called SOC. SOC. And this one will tell us what is the movement of my share capital, share premium, and revaluation reserve and return earnings account. So this is the part of the equity. Equity. I'm sure all of you know what is the equity. So the company have a capital, isn't it? If I like to do a business, I need capital. And if I break the capital, there is two things will come out. One is called debt and one is equity. So debt is the money come from outside, for example, from the bank, from my friends and family. If I loan the money, this is called debt. And if something come from my pocket, this is called equity. So for example, my capital is 10,000 and 5,000 I took from the bank and 5,000 from my savings. So this one is called equity. Now equity have few part. We have a share capital, share premium, return earnings, and revaluation reserve. This four thing is included on the equity. All right, so this one is a part of the accounts. That finally is notes to the financial statement. This is also part of the financial statement because some of the people they are not from the accounting background. So there are few people they're not from the accounting background, they're from the different background. So obviously they will not understand what does that mean deferred tax, what does that mean, the capital, what does that mean, the receivables. So for them, we have to write the meaning of that. For example, we write depreciation, and we said depreciation means it's the reduction of the value of the non-current asset. So the people, the normal people, the general people, they're not from the accounting background, they will understand what is the meaning of the depreciation. So writing the important matter in detail, very simple way explain, is called notes to the account, and it's very important. It wasn't mandatory before, but last few years, like it's been like 7 8 years, so every company have to put the notes to the accounts when you submit information to HMRC, because HMRC said there's a lot of people from the non-financial background. They have to understand what does that mean, otherwise they might choose a wrong decision, because they will not end up with the wrong decision. So this 5 thing is the part of the accounts except the director report. So we can say this one, this one. So number 1 2, then 5 4 5 and 6. So this all is the part of the accounts, the five parts of the accounts. So there's total 5 parts. All right, this is not difficult. So let's have a look what else we have in this chapter. I don't think so. We have much thing here. This is the template of the financial statement. I think this is not very new to us. So profit and loss account of the financial statement. This is the part of the equity. I already explained that. Share capital, share premium, retained earnings, and the revaluation reserve. And I don't think so. We have much thing here. So this is we have issue a share capital at premium. So let's have a look. How can you do that when you issue the share capital with premium? So as we already know, anything if I sell more than the nominal value is a share premium. So let's say the question is here is on 1st of July 2004, Orion Limited issue a further 200,000 ordinary share of 50 pence each for 80. So basically the nominal value is 50 pence, but I'm selling it for 80. So I'm selling 80 pence minus 50 pence. So 30 pence I'm selling every share above of the nominal value, isn't it? So if I charge anything above of the nominal value, this is called share premium. So it will go share premium account. So I said, obviously, if I sell 80,000 or 200,000 ordinary share, so I'm going to say 200,000 ordinary share I'm going to sell. I'm going to sell for 80 pence. So definitely all of this cash will come. So that's my asset. So if I do that, so that will give me my asset, the cash I'll raise. So that's my asset. And out of these 80, so I would say 200,000. So I have 50 pence for the share capital and 30 pence for the share premium account. So I'll do separate way. So I'll say my asset, the question said using the information from illustration 1. Okay, so illustration 1, we have already cash 50,000. So we said we already have 50,000 plus this one gave me 160,000 because of the issue of the 200,000 share 80 pence each. That gives me 210. And for the equity have a two part now because I'm selling more than 50 pence. So in the equity, I have share capital that is 200,000 times 50 pence. That gives me 150,000. And the share premium, that gives me how much? That is 30 pence each for the 200,000. That gives me 60,000. So share capital is 150. Of course, 50 we already have from the before. The question said from the illustration 1. So if you look at the illustration 1, we already have 50,000. So you added 50. So total, we have 160,000. So out of 160,000 of the capital, 100,000 for the share capital and 60,000 for the premium. We understand because 50 pence for the share capital and 30 pence for the premium. So anything if you sell more than the nominal value, that goes to the share premium account. All right, that's not difficult. Let's move on. Is there anything else we have? The bonus issue, as we said, the bonus issue doesn't affect the this doesn't raise the new capital from the market, but it will be used by different account to bring the money to the share capital account. But the question will tell you what to do. So let's have a look. This question, what we have here. So in this question, we can see they said Dark Limited has the following equity: share capital, that is £1 ordinary share, that's the nominal value; share premium 40,000, retained earnings 200,000.